What if I told you? What was I going to tell you again? That institutions are enriching themselves through a private pyramid-like investment strategy surrounding Bitcoin that's SEC approved, and it's retail investors who are paying the price. But that it's also good for Bitcoin. Okay, that one made me feel a little bit dirty. Today, ladies and gentlemen, I will provide proof that this is being conducted at a massive scale and is very morally gray, which must be how they got their name. I will tell you what the Grayscale Effect truly is and how it has been significantly inflating the price of Bitcoin, Ethereum now too, with no end in sight. But first, please delicately caress that like button. It helps me out a lot and helps more. Just before that, breaking news. According to a just filed SEC submission, Tesla has acquired $1.5 billion worth of Bitcoin.
Oh my God! Okay, it's happening!
We invested an aggregate $1.5 billion in Bitcoin under this policy and may acquire and hold digital assets from time to time or long term. Amazing, fantastic news, but it gets even better. We expect to begin accepting Bitcoin as a form of payment for our products in the near future, subject to applicable laws and initially on a limited time basis, which we may or may not liquidate upon receipt. Not at all surprised to see him frame it like this, but what are they going to do with their Bitcoin? Are they going to hold on to it? Are they going to sell half? Are they going to sell all? I would imagine they're not going to sell all. I don't know. I'm only theorizing. I know that Bitcoin is difficult to acquire in large amounts, and accepting it as a form of payment is actually a fantastically efficient way to do it. Now, why is this such a big deal? Why is everyone talking about it? Tesla is obviously a very forward-thinking company, having revolutionized the electric car industry. One of the reasons Elon was able to pull off the meteoric rise of his company was in part by being so transparent on Twitter. Now, you may think I'm minimizing Elon's achievements by talking about his Twitter. After all, the guy posts a lot of crap on there. But his level of transparency about his business, about difficulties they face, has garnered him a loyal fan base. It has been amazing marketing, honestly, for Elon and Tesla. It's difficult to quantify exactly how valuable it is, but it's pretty clear it's a very powerful thing. So the single richest person that we know of in the world sets the example for all corporations worldwide and to tens of millions of devoted followers. I mean, what could get better than that? I wish he didn't tweet about Dogecoin though. I didn't see you buy 1.5 bill of anything else other than Bitcoin here. Funny that. Anyway, back to what institutions don't want you to know. So what is the Grayscale Effect? Let's get into it. According to BitcoinTreasuries.org, a site that tracks, what do they track? Bitcoin holdings for publicly traded investment firms, there is one organization that trounces everyone else's holdings by a huge amount, even MicroStrategy, who have a very impressive 71,000 Bitcoin or 2.9, sorry, the price keeps going up, and who seemingly keeps adding to it randomly. Even they don't come close to an ETF like Grayscale Bitcoin Trust at 649,000 Bitcoin or 26.5 billion. That is 3.1% almost of the entire Bitcoin supply, currently growing at a rate of about $1 billion per month. Wow. How are they so much popular than anything else? In fact, other SEC filings reveal that a growing number of major institutions are investing in the Grayscale Bitcoin Trust, including ARK Investment, Kinetics Investment Group, Rothschild Investment Corp. You get the point. What's also really crazy about this, though, is that they don't even offer you a good deal. Since inception, buying Bitcoin and storing it with Grayscale has on average cost you 38% higher than the actual value of Bitcoin bought off of Coinbase or Binance, for example. Who the hell would pay near 40% more than they need to for Bitcoin? How in the hell are they doing this? Well, Grayscale do have leverage. They were the first to market with an SEC-approved investment vehicle for institutional clients in the US. So if you, your company, your wealth management fund, or even an institutional investor who is not in the inner circle and wants exposure to Bitcoin through an SEC reporting company, well, you really don't have that many options, hence why many are willing to pay the premium. And here's where they begin to take advantage of this situation, this monopoly that they have going on. You see, when you buy Bitcoin through Grayscale, they issue shares to represent it. 1,000 shares is equal to 1 Bitcoin. These shares are almost always overpriced. If, however, you are amongst an inner circle of approved private investors, you can get hold of these shares for the rate they should be through a small loophole. If you deposit Bitcoin with them instead of buying with cash, which is allowed every 6 months to this private group, then you will be issued shares with 0 premium, which you can then sell on secondary markets at a premium and pocket the difference. But what proof do I have that this is what they're actually doing? According to the Digital Asset Investment Report, almost 80% of funds raised are done in Bitcoin, the rest being cash. Unfortunately, since Q3 of 2019, they no longer publish this exact information. I wonder why, but even back then we can see what they were up to. They've stopped reporting it because they don't want you to know it, even though the evidence is pretty obvious. I think that's what they're still doing, and in fact, I think that they are taking out loans for even more Bitcoin to make even more money. It's why organizations like BlockFi have cropped up to meet this demand. You may wonder how 6% annually paid in Bitcoin is at all sustainable, but when you see the premiums that are currently going on for these Grayscale Bitcoin Trust shares, today at 6%, which is historically kind of low, 10% a few days ago, if you can borrow Bitcoin at a good rate from someone like BlockFi, turn around and immediately make 10%, then you would do it. Demand for Bitcoin is almost infinite, which is why these Bitcoin loan companies are effectively printing money. I think there will always be a demand for Bitcoin, but as long as a premium remains high, there will be a ridiculous demand for Bitcoin, no matter the current price per coin. 40,000 or 1 million per coin does not matter at all. Institutions who maybe don't believe in a decentralized currency or the store of value proposition don't have to. It's settled in cash and comes with very little risk. In addition to that, money really only goes in and does not come out. The people who are buying these shares aren't incentivized to cash them in for Bitcoin at these premiums. This creates a feedback loop where private Grayscale investors buy Bitcoin, the price of Bitcoin goes up, demand for these shares goes up, which is the perfect relationship of their own making. Grayscale have become somewhat of a black hole of liquidity, wanting as much Bitcoin as they can get a hold of and never actually selling the underlying asset. Extremely good for price. Consequently, some have made the observation that every 6 months, which is the only time that these private investors are allowed to create these new GBTC shares, there is a significant impact on the price of Bitcoin. The next 6-month period started this week, the same week Michael Saylor held a conference for institutions on how to buy Bitcoin. This rally was definitely planned. Now, there's plenty of research on this topic done by @BenLilly on HackerNoon, which I'll leave linked below. He's given evidence of every time that these shares open up, there is a significant impact on price. Very interesting. I'm not going to say that a chart like this is created by any one thing. I think you might fall into a trap of looking like you don't know what you're talking about as you're trying to look like you know what you're talking about. There's plenty of reasons that this has occurred, not just Grayscale. But the positivity here is undeniable. In fact, for some, observable. So what are the risks here? I would expect far less institutional demand as these premiums slip, if they do. Funnily enough, the biggest threat to that happening is a Bitcoin ETF approval, which would be devastating to this entire business model, but if passed, obviously brings its own benefits, so I'm not honestly that concerned. The price premium, though, should be used by analysts attempting to gauge market conditions, as it does have a significant impact on Bitcoin. It cooled off recently, just as Bitcoin slumped, and was predictable that this was going to happen. This article was posted in December, and he said the next major unlocking is set to happen around February 3rd, 2021, meaning the next time period from December 29th to the next unlocking will be void of unlockings. Because of this, I expect price to either consolidate or sag. But for me, the most interesting thing that is happening right now is what they're doing with Ethereum. Purchases were paused for a few months and have only just reopened again. The premium for the ETH contracts, currently 20%. That is insane. ETH is definitely hitting 2K likely very, very soon. I am not at all surprised to see $38 million buys just yesterday. This is an insane opportunity to the inner circle to make money, essentially an arbitrage opportunity for the rich and powerful to earn off the less rich and powerful, all caused by the fact that the SEC won't allow retail investors to play on an even playing field. I actually read a quote by Mark Cuban about the SEC's incompetence, which I think eloquently describes what's going on. It was during a Reddit AMA about the whole GameStop situation, but definitely applies here too. The SEC is a mess. I wouldn't trust them to do the right thing ever. It's an agency built by and for lawyers to be lawyers, whatever, and win cases rather than do the right thing. If the SEC gave a crap about anyone other than Wall Street, you would be able to go there right now and read bright line guidelines about insider trading, shorting, what is a pump and dump, what are the rules for cutting off purchases of stocks, like what happened with GME, etc. But they won't. They would rather litigate and regulate, which means they love to sue people in order to create new legal precedents. All you need to know about the SEC and how badly they want to F with the little guy is that they have the option of using judges that work for the SEC when they sue you, rather than you have the option to have jury of your peers in front of a judge that is independent. That's how bad the SEC is. Okay, right. Okay, yeah. That kind of makes sense. So, yeah, the little guy is getting dumped on by the big guy. Surprised Pikachu. What should you do about it? Just don't buy Bitcoin or Ethereum through Grayscale if you can. Then you actually benefit from all this. I am super bullish as long as this contract premium remains. It doesn't necessarily need the premium, but if there is one, game over. Anyway, that's it from me. Leave a like if you enjoyed. I'd love to hear from you down below. Subscribe if you haven't, and I'll see you in the next one.
What's up, everyone? Today I'm back to do another quick project overview pretty quickly. Today I want to talk about DeFi Bids, which is a fully decentralized auction site that allows users to bid on bundles of existing ERC20 tokens. When a user bids on an auction package, a portion of their bid is distributed across all users staking the bid token. As usual, I'm not a financial advisor. Please always do your own research. All right, let's jump into it. Bid small, win big. This is the platform's catchphrase, with the first type of auctions that they're going to be introducing as strategy-based auctions called Lowest Unique Bid Auction, or LUB. For example, a bidder will be able to bid on a package of ETH and win it for a bid of $2 using DeFi Bid credits. If their bid is the lowest number, and that bidder is the only person to bid that number, they will then win the 5 ETH package. To participate in the auction, the bidder will be required to pay a fee for each bid placed, which makes sense. Each bidder can place as many bids as they'd like on how many auctions they'd like for a better probability of winning. Once the bid bar fills, the auction will end and the winning bidder will be required to pay whatever that bid was. There's going to be multiple auctions that will be running at the same time, and once one auction ends, another one will start. All auctions will be curated by the DeFi Bids team, meaning that a regular user can't set up an auction. You can imagine with enough people utilizing the platform that the revenue made from each auction will be more than enough to cover the cost of the auction packages. This auction style, along with other types to come, have the possibility to create a very lucrative revenue model for the DeFi Bids team and those staking the bid token. Packages of tokens and stablecoins aren't the only thing that can be auctioned off. The platform will also be supporting and auctioning off NFT tokens, which has become the next big thing in crypto. DeFi Bids has a native token, which is called the bid token. The tokenomics for bid are deflationary, as every transaction has a 2% fee. 1% of it is burned, and then the other 1% of it goes to the staking pool. This means that every time you buy, sell, stake, unstake, or send from wallet to wallet, that 2% fee will be applied. For those staking the bid token, every 24 hours, the rewards from the 1% of the fees in auctions are allotted to the stakeholders in the side pool. Stakers can choose to reinvest or withdraw the rewards, and then withdrawing, there's a 48-hour period before the tokens will go to your wallet. Your portion of staking reward is based on the percentage of the staking pool, which is a pretty common practice. The more transactions on the network, the more rewards each staker is going to earn. And that isn't the only rewards that stakeholders will earn though. After the auction ends, 15% of the profit will go into the staking pool. Stakeholders will earn bid tokens as well as ETH from those auctions. The idea is that the staking model will incentivize people to stake their bid tokens, and this will reduce the circulating supply and drive up the token's value. Another nice feature is that you can also earn ETH by promoting DeFi Bids among your friends and your followers using a referral link. 5% of all the ETH spent on the platform by those you refer for life is paid out to you in ETH instantly as they buy credits. If you're familiar with MetaMask, you can link your wallet directly to the site. And if you want to purchase the token outright, you can do so on Uniswap. All right, so my thoughts on the platform. I personally wouldn't use something like this just because I'm not much into gambling or auctions. That being said, it does look like something that could be fun if done correctly, and you may actually be able to win something worthwhile. I like that the team picks what auctions are going to be run because I think if we left it up to users, it would probably end up being like a mess of all different kinds of tokens. My normal disclaimer, for crypto in general, but specifically for anything like gambling related is going to apply here. Don't bet on something that you're not willing to lose. I personally did not try to bid on anything on the website, so I can't speak to the functionality, but I can say that the design is a little cluttered. I would have liked to have seen, a more detailed white paper too, or even maybe a more centralized location where I could have gone to find more specific information about the project itself. Evidently, the team is anonymous by design because of the nature of the website. I don't know. That worries me a little bit too. But if you're not overextending yourself on the site, again, I feel like it could possibly be fun. All right, everyone. That wraps it up for me today. Thanks again for watching and take care.